Welcome to Illuminati Silver. We tell you the truth about silver. Today is Thursday, the 8th of December 2016, and we're commenting on the European Central Bank's decision today to both extend and taper its QE program. Most European stock markets rose today between 1 to 2%, following the European Central Bank's decision to extend its asset purchase program by 9 months, longer than had been expected, while cutting the size of monthly purchases. The ECB loosened restrictions on the assets it could purchase, and President Mario Draghi gave a dovish press conference where he said the level of purchases could rise again if needed. In essence, 1. The ECB extends QE until December 2017, and 2. The new €60 billion a month rate was introduced, but would not begin until April 2017. While many investors were confident of dovish messages from the European Central Bank, few saw a tapering coming. It seems that the central bank has become stuck between two opposing interests. The other central banks, which are against extended quantitative easing, and the public, which is still looking to the ECB for fiscal stimulus. George Selgin, senior fellow at the Cato Institute, describes the situation extremely well, and we quote him. The ECB is playing a difficult and dangerous game. It wants to reassure its more hawkish critics, including German representatives on its governing council, who voted against the current purchases, that its quantitative easing deadlines aren't meaningless. The ECB also wants to give the public some forward guidance by committing itself to a definite policy course in the future. Besides countering uncertainty, which itself acts as a drag on investment and growth, an advanced commitment to future easing is intended to enlist the public's help in boosting spending and interest rates by raising today's inflation forecasts. Consequently, central bankers, by placing too much emphasis on current conditions, can end up contributing to economic instability instead of combating it. When central banks commit to future policy actions in advance, as they do when they make use of forward guidance, they're even more likely to end up regretting their actions." Unquote. The reaction has been the immediate fall of the euro by 1% to $1.06, where it currently stands. We remember back to 11th of March 2015, where the euro slipped to $1.0599, below $1.06 for the first time since April 2003. We can now see it falling potentially further against the dollar, especially if the Federal Reserve raises rates next week. Euro-dollar parity should not prove surprising, and the impact on the gold market is that although gold has fallen by $2 today, in euro terms it has risen by 12 euros. With further weakness still expected, we should not be surprised to see gold and silver purchases increase again within the Eurozone. Though for the moment, the stock markets are the flavour of the month. We hope you have found this video interesting and informative, and if so, please give it a thumb up and share it on Twitter. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe as a free member for regular email updates and offers. Our Facebook page, which is updated daily, can be found at facebook.com/illuminatisilver. Disclaimer. Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice, and merely represent the personal views of its owners.